Oil is often called the lifeblood of the modern economy, and for good reason. Nearly every product we use, every package we receive, and every mile we travel depends in some way on oil. From fueling cars, trucks, ships, and airplanes, to powering factories and supporting agricultural production, oil touches almost every corner of economic activity. Because of this, changes in oil prices can send shockwaves through the global economy, affecting businesses, governments, and ordinary families alike. The relationship between oil prices and global economic health is not a modern phenomenon, but rather a fundamental truth that has shaped civilization for over a century. To truly understand how oil prices control the global economy, we must examine the intricate web of connections that bind energy costs to economic outcomes across every continent and sector of human activity. Imagine a truck driver named James who transports goods across the United States. When oil prices are low, fuel costs remain manageable, allowing trucking companies to keep shipping expenses under control. Stores can stock products at reasonable prices, businesses can maintain profits, and consumers can afford to spend money on other things. Economic activity flows smoothly because transportation, the backbone of modern commerce, remains relatively inexpensive. James can complete his routes efficiently, his employer maintains healthy profit margins, and the entire supply chain operates with predictable costs. But then global oil prices begin to rise. Perhaps a major oil-producing region experiences conflict, production cuts, reduced supply, or demand suddenly increases as economies grow. Whatever the cause, the price of crude oil climbs rapidly. James notices it first at the gas station, where diesel prices jump significantly within days or weeks. His employer faces higher operating costs and begins charging more for deliveries. Soon, manufacturers pay more to transport raw materials, retailers pay more to stock shelves, and airlines face rising fuel expenses. The ripple effect becomes undeniable as each transaction in the global supply chain carries the burden of elevated energy costs. As these higher costs spread through the economy, prices begin increasing everywhere. Food becomes more expensive because farmers use fuel-powered machinery and transportation networks to grow, harvest, process, and deliver crops to markets around the world. Airline tickets cost more, forcing families to reconsider vacation plans and businesses to reduce travel budgets. Utility bills rise as electricity generation becomes more expensive, whether through natural gas power plants or the operational costs of renewable energy facilities. Businesses pass additional costs to consumers whenever possible, creating a domino effect where price increases accumulate across every layer of production and distribution. Inflation starts accelerating, reducing the purchasing power of households. Families find that their paychecks no longer stretch as far as they once did. A salary that covered all expenses comfortably becomes insufficient when prices surge across groceries, transportation, heating, and basic services. This erosion of purchasing power creates real hardship for millions of people who have no direct connection to oil markets but experience the consequences through every purchase they make. The mechanism by which oil prices influence inflation is both direct and indirect. Direct impacts occur when oil and oil derivatives appear as inputs in products consumers purchase, such as gasoline for vehicles, heating oil for homes, and plastic materials in countless products. Indirect impacts occur through supply chains, where transportation, manufacturing, and distribution costs rise, eventually reflected in retail prices. A person who never drives a car still consumes products transported by trucks, shipped across oceans, and delivered by air freight. The energy embedded in nearly every good and service means that oil price increases translate into widespread price increases across the economy. This relationship is so consistent that economists closely monitor crude oil prices as a leading indicator of future inflation. When crude oil surges, they know that inflation will likely follow within weeks or months as cost increases work their way through supply chains and are passed to consumers. Conversely, when oil prices decline sharply, inflation pressures ease, and consumer purchasing power begins to recover. This predictable relationship has proven true across decades and across different economic systems, demonstrating how fundamental oil is to the functioning of modern economies. Governments and central banks closely monitor oil price developments because they understand this dynamic profoundly. When oil becomes too expensive, consumers spend more money on energy and less on discretionary purchases, such as entertainment, travel, luxury goods, and dining out. This shift in spending patterns reduces revenues for businesses in non-essential sectors, potentially leading to layoffs and slower economic growth. Businesses may delay investments and hiring due to higher costs and uncertainty about future demand. Construction projects pause, manufacturing expansion slows, and companies become cautious about committing to new ventures when the cost of operations is rising unpredictably. Economic growth can slow significantly, and in extreme cases, economies may enter recession. Throughout history, several major economic downturns have been preceded by sharp spikes in oil prices. The oil crises of the 1970s, following OPEC embargoes, contributed to stagflation in developed economies, where growth stalled while inflation soared. The energy price spikes preceding the 2008 financial crisis added pressure to already fragile markets. In 2022, energy price surges following Russia's invasion of Ukraine pushed inflation to its highest levels in decades across developed nations. These historical patterns demonstrate that governments cannot ignore oil prices because they directly influence employment, income, and overall economic stability. Central banks face a profound dilemma when oil prices surge. Their traditional tools for managing inflation involve raising interest rates to reduce spending and cool the economy. However, oil price increases that stem from supply shocks rather than excessive demand create a unique problem called stagflation potential, where raising interest rates may slow growth without adequately addressing the underlying cause of inflation. A central bank might raise rates to fight oil-driven inflation, only to tip an economy into recession while the oil price inflation persists regardless. This creates policy tension and uncertainty that itself can damage economic confidence and investment decisions. Businesses become hesitant to make plans when they cannot predict what interest rates will be or how policymakers will respond to energy shocks. Consumers become cautious about major purchases like homes and vehicles when they face both rising costs of goods and higher borrowing rates. This uncertainty cascades through financial markets and investment decisions, sometimes creating additional economic damage beyond what the oil price change alone would cause. Understanding these policy challenges reveals why oil price stability is viewed as a strategic priority by governments worldwide. Oil prices also shape global politics and international relations in ways that extend far beyond economics. Countries that export large amounts of oil often benefit tremendously when prices rise, because they earn more revenue from exports with the same production levels. Saudi Arabia, Russia, the United Arab Emirates, and other major producers see their government budgets swell during oil booms, allowing them to fund infrastructure projects, military spending, and social programs without raising taxes. This economic windfall translates into political influence on the global stage. Nations heavily dependent on imported energy, however, may struggle with trade deficits and inflation. Importing countries must spend more foreign currency to purchase the same amount of oil they previously bought, draining reserves and creating current account imbalances. As a result, oil-producing countries can wield significant economic influence over energy-importing nations, which include most developed economies in Europe, Asia, and even parts of North America. Decisions made by major producers and organizations such as OPEC can affect energy markets and economic conditions across continents. When OPEC countries agree to reduce production, global oil prices rise, benefiting all oil producers while harming oil importers. When production increases, the opposite occurs. This power dynamic has shaped international relations, influenced military interventions, and determined which countries hold economic leverage in negotiations. The desire to secure reliable energy supplies has influenced foreign policy decisions and alliance formations throughout the modern era. The energy security concerns arising from oil dependence have influenced geopolitical strategies for generations. Nations seek to ensure they have access to affordable oil regardless of international political developments. This has led to strategic partnerships with oil-producing nations, military bases near energy-rich regions, and significant defense spending to protect global shipping lanes through which most international oil trade occurs. The Strait of Hormuz, through which approximately one-third of global seaborne oil passes, has become a critical choke point that nations monitor closely. Any disruption to shipping through this narrow passage could dramatically reduce global oil supplies and send prices soaring. This geographic concentration of energy resources means that political developments in specific regions, such as the Middle East, can have immediate and significant impacts on global economies thousands of miles away. A political dispute between two nations in the Persian Gulf, a military conflict, or even political tensions that threaten supply can cause energy traders to bid up prices preemptively, not because current supplies are disrupted, but because the risk of future disruption has increased. This forward-looking pricing mechanism means that actual shortages do not need to occur for energy prices to spike and economic disruption to begin. For James the truck driver, the connection between distant oil-producing regions and his own financial well-being becomes clear over time. A change in oil prices is not just a number reported on financial news channels or discussed in economic reports. It affects the cost of transportation, food, housing, travel, and countless everyday expenses. What happens in oil fields thousands of miles away, in geopolitical disputes affecting production capacity, or in decisions made by energy companies and government agencies, directly influences the financial well-being of families around the world. A truck driver in Texas, a farmer in India, a factory worker in Poland, and a retiree in Japan all face the same fundamental reality. Their economic circumstances are influenced by oil markets they do not directly participate in, and in many cases barely understand. This invisible connection between global energy markets and individual economic security creates systemic vulnerability in modern economies. As oil prices swing up and down based on global supply and demand conditions, countless ordinary people experience swings in their own economic security and quality of life. The transmission of oil price changes through supply chains happens with remarkable speed in the modern globalized economy. When crude oil prices rise, energy companies immediately begin charging more for petroleum products. Transportation companies adjust fuel surcharges within days. These surcharges appear on shipping invoices, airline tickets, and delivery costs almost instantly. Manufacturers who rely on oil-derived materials or energy-intensive production processes adjust their prices to retailers within weeks. Retailers then adjust their retail prices to consumers. In many cases, grocery stores, for example, adjust prices to reflect higher fuel costs and transportation fees within days or weeks of oil price increases. Consumers experience these price changes at checkout counters across the world simultaneously. The speed of modern supply chains and digital price-setting systems means that oil price shocks transmit through economies faster than at any previous point in human history. A major oil price change on Monday can result in higher prices at grocery stores by Friday. This rapid transmission means that oil price shocks have immediate and visible impacts on household budgets, potentially affecting consumer confidence and spending decisions very quickly. Different economic sectors experience oil price changes differently based on their energy intensity and ability to pass costs to consumers. Transportation and logistics companies face direct impacts through fuel costs and must pass these increases to customers through surcharges and higher prices. Airlines, already operating on thin profit margins in competitive markets, face particularly acute pressure from jet fuel price increases. Manufacturing companies using petroleum-derived materials or energy-intensive processes face significant cost pressures. Agriculture faces substantial impacts through equipment fuel, fertilizer production costs, and transportation expenses. Retail and consumer goods companies face impacts from increased transportation and logistics costs. Financial services and technology companies have lower direct exposure to energy costs, but still feel indirect impacts through broader economic effects. Real estate values may shift based on energy cost implications for property owners and occupants. Understanding these differential impacts reveals why oil price shocks create unequal economic consequences across sectors and income levels. Some businesses thrive during oil price increases by raising prices efficiently, while others struggle to maintain profitability. Some workers in energy-intensive industries face job losses during high price periods, while others in digital sectors may remain largely unaffected. This creates economic disruption and inequality effects that extend beyond simple price changes. The relationship between oil prices and employment is particularly significant for understanding the economic impact of energy costs. During periods of rising oil prices, businesses face elevated costs and may reduce hiring or lay off workers to maintain profitability. This creates unemployment in sectors affected by higher energy costs and reduced consumer spending. Transportation and logistics companies may reduce staff. Manufacturing facilities may run reduced hours or close plants. Construction companies may postpone projects when material costs and transportation costs rise unexpectedly. Retail companies facing reduced consumer spending may cut hours and staff. Airlines and tourism companies may reduce flights and services as demand falls and fuel costs rise. This creates a positive economic cycle with job growth and rising incomes. The employment effects of oil prices demonstrate that energy costs are not abstract economic indicators, but direct influences on whether people have jobs, can pay their mortgages, and can support their families. Historical analysis reveals clear patterns in how oil prices influence economic performance and employment cycles. The 1970s oil crises, when OPEC placed embargoes on countries supporting Israel, reduced global oil supplies by approximately 5 million barrels per day. At a time when global consumption was around 50 million barrels daily, prices quadrupled as markets faced genuine shortage and uncertainty about supply restoration. The resulting inflation and economic damage contributed to recessions across developed economies and unemployment reaching double digits in some countries. The shocks made clear to governments and economists that oil supply disruptions posed fundamental threats to economic stability. The early 1980s oil price collapse, when production increased and demand fell due to recession, demonstrated the opposite effect, with lower energy costs, supporting economic recovery and reducing inflation. The 1990s featured relatively stable oil prices and consistent economic growth across developed nations. The 2000s saw sustained oil price increases as demand from rapidly growing China and India collided with limited supply growth, driving prices from $30 per barrel to over $100 per barrel. This extended period of high oil prices coincided with significant economic pressures, including the 2008 financial crisis that was exacerbated by energy costs. The 2010s featured volatile oil prices from below $30 to over $100, creating periodic economic headwinds. The 2020s began with a dramatic price collapse due to pandemic-related demand destruction, followed by price recovery and then another surge following Russia's invasion of Ukraine. In each case, oil price movements correlated strongly with economic performance, employment trends, and inflation rates. The historical record provides overwhelming evidence that oil prices exercise substantial control over economic outcomes. The elasticity of oil demand and supply determines how dramatically oil prices move in response to supply and demand changes. Oil demand proves relatively inelastic in the short run because people need to heat their homes, power their vehicles, and operate their factories regardless of price. Consumers cannot immediately switch to different fuel sources or significantly reduce consumption even as prices rise. This inelasticity means that relatively small changes in supply or demand can cause large price swings because quantities traded do not adjust as much as prices do. A 2% decrease in daily global supply, seemingly modest, can cause dramatically different pricing depending on how tight the market is. If demand is very high and spare capacity is low, a 2% supply decrease might cause prices to double or triple. If demand is soft and spare capacity exists, the same supply decrease might cause prices to rise modestly. Similarly, sudden increases in demand as economies grow rapidly, or sudden decreases in demand during recessions, can cause large price swings. This inelasticity makes oil markets inherently volatile and creates the potential for large price shocks that cascade through economies. The price volatility creates uncertainty for businesses trying to plan investments and consumers trying to budget for essential expenses. Economists debate whether this inherent volatility is problematic and whether government policies should attempt to stabilize oil prices through strategic reserves or other mechanisms. Speculation in financial markets also amplify oil price movements beyond levels justified by physical supply and demand fundamentals. Oil is traded not just as a physical commodity delivered to refineries, but as a financial asset in futures markets where traders bet on future prices. Large investment funds hold positions in oil markets, and their buying and selling decisions can influence prices. When geopolitical tensions or supply concerns emerge, speculators may bid up prices in anticipation of potential disruptions. This forward-looking behavior can cause prices to spike before actual supply disruptions occur, potentially causing unnecessary economic damage by raising costs when supplies remain adequate. Conversely, when economic concerns emerge, speculators may sell positions, driving prices down more dramatically than underlying demand changes would justify. This financial market activity adds another layer of volatility to oil prices and makes them less purely reflective of underlying physical supply and demand. Some economists argue that limiting speculation or improving market transparency could reduce excessive volatility. Others contend that speculation actually improves market efficiency by incorporating all available information into prices. Regardless of this debate, the reality is that modern oil prices reflect both physical realities and financial market dynamics, and both components influence the economic impacts of energy costs. The relationship between oil prices and economic growth has been the subject of substantial economic research. Econometric studies consistently show that sharp oil price increases reduce economic growth, while oil price decreases support economic expansion. The estimated impact varies across studies, but generally finds that a $1 increase in the average price of crude oil per barrel, sustained for a year, reduces global economic growth by approximately 0.1 to 0.2 percentage points. This may sound modest, but applied to a global economy that grows around 3% annually, a $10 per barrel oil price increase sustained for a year could reduce growth by 1 to 2 percentage points, cutting growth roughly in half. For developing economies dependent on oil imports and with less financial flexibility, the impacts tend to be more severe. The lag between oil price changes and economic impacts typically extends over several quarters as cost increases work through supply chains and inflation adjusts. This lag creates challenges for policymakers who must decide whether to respond to current oil price developments or wait for actual economic data to confirm their impacts. Meanwhile, if prices reverse before the full economic impact materializes, policy responses might prove counterproductive. This timing uncertainty adds to the challenges of managing economies affected by oil price shocks. The global transition toward renewable energy and away from petroleum dependence represents a long-term shift that will eventually reduce oil's control over economic outcomes. Solar, wind, geothermal, and other renewable energy sources are increasingly cost competitive with fossil fuels. Electric vehicles are rapidly increasing in market share and eventually may substantially reduce petroleum demand for transportation. Improvements in energy efficiency reduce the energy intensity of economic production. These transitions are genuinely underway and will continue accelerating in the coming decades. However, this transition will take decades to complete. Current projections suggest oil will remain a major energy source through mid-century. During this extended transition period, oil prices will continue to exercise significant influence over global economies. The speed of the transition also remains uncertain and dependent on technological breakthroughs, policy decisions, and investment levels. If the transition accelerates more rapidly than currently expected, oil's economic influence will diminish faster. If technological challenges prove more difficult than anticipated or political commitment weakens, the transition will extend longer and oil will retain its economic importance for a longer period. Either way, oil will significantly influence global economies for at least the next 2 decades, regardless of current transitions underway. The energy security implications of oil dependence create strategic concerns for governments and influence military spending and foreign policy. Nations invest in military capabilities to protect shipping lanes, maintain bases near oil-producing regions, and ensure they have reliable access to energy resources. Military interventions in oil-producing regions have been influenced by energy security concerns, though typically not as the sole motivation. The costs of military spending to secure energy resources represent a form of implicit subsidy to oil consumption that is not typically reflected in prices consumers pay. Some economists argue that if these security costs were fully reflected in oil prices, they would be substantially higher, which would accelerate the shift toward renewable energy. Others argue that military spending reflects broader geopolitical concerns beyond just energy security. Regardless, the connection between oil markets and military strategy reveals how central energy is to national security and international relations. Rising powers like China and India must ensure access to adequate oil supplies as their economies grow, shaping their foreign policy and alliance decisions. Established powers like the United States maintain military capabilities to influence global energy markets in ways that support their interests and those of their allies. Looking forward, the question of how oil prices will influence economies depends on several interconnected factors. First, the pace of renewable energy adoption will determine how quickly oil demand is displaced. Second, geopolitical dynamics in major oil-producing regions will determine supply stability and whether disruptions may occur. Third, global economic growth rates will determine demand pressures on available supplies. Fourth, investment in oil exploration and development will determine supply responses to price increases. Fifth, financial market dynamics and speculation will influence price volatility around underlying supply and demand fundamentals. Sixth, government policies regarding energy, climate change, and economic management will shape all these factors. With so many variables in play, predicting oil prices and their economic impacts remains inherently uncertain. However, the fundamental reality remains consistent. Oil will continue to exercise substantial control over global economic outcomes for at least the next several decades. Businesses and individuals who understand this relationship and anticipate oil price movements can better prepare for their implications. Those who ignore oil market dynamics risk being caught off guard by economic shocks and lacking adequate responses. For James, the truck driver, and millions of people like him, understanding oil's role in the global economy is not merely an intellectual exercise, but a practical necessity for navigating economic uncertainty and protecting their financial well-being. The oil that powers his truck fuels the ships delivering goods to stores and generates electricity for homes and factories around the world, remains fundamentally connected to the economic security and prosperity of people everywhere. As long as modern civilization depends on petroleum energy, oil prices will continue to exercise the powerful influence they have held for over a century, shaping prosperity and hardship, employment and unemployment, growth and recession across the global economy. Understanding this relationship is essential for anyone seeking to comprehend how modern economies actually function and where future economic risks and opportunities may emerge.